on today's financial literacy briefing. Today we are going to explore one of the most fundamental principles in the entire financial world, the risk-return trade-off. Think of this concept as an investor compass in a financial markets. Just a compass kit, a traveler through unfamiliar terrains, understanding the relationship between risk and return help us navigate complex investment choice. At its core, this principle describes how risk directly shape our expected rewards, meaning that if you want the potential for a higher returns, you must be willing to accept a higher sense of volatility or loss over the next few minutes. We will break down exactly how this balance works so you can make more informed, confident decisions with your money, and let's get started to look this. Now let's demystify what you call the golden rule of the markets. Every single investment decision boils down to an internal negotiation between two competing forces, our desire for growth versus our fear of losing money. To break this down simply, think of it in a three-chord truth. First, absolute certainty doesn't exist in investments. No return is ever guaranteed without taking on some form of uncertainty. Second, we don't take on a risk for free. Investors demand a higher potential reward as a compensation for taking on a higher volatility. Third, and this is a crucial nuance, the relationship is directional, not perfectly proportional. Just because you take on double the risk does not mean you are guaranteed double the reward. In fact, risks can often climb much faster than your potential returns. As you can see in the visual breakdown, on the right potential gain and the risk of lose move upwards together always. Once you internalize this concept, you stop being shocked or surprised by sudden market movement. Instead, you become an informed investor who uses this rule to build a smarter portfolios. Moving on to slide 2. Let's look at the actual mechanism of how this play out across different asset classes. As a rule, market compensates investors for bearing uncertainty. When the expected return of an asset rise, it isn't just a higher point on a chart. The entire range of possible outcomes widens, including the potential downside. If you look at the graph, we can trace this directly from left to right. On the far left, we have cash and T-bill represented by the green dot. This is your lowest risk, but consistently your lowest return. Moving up, the blue dot represents government bonds, offering moderate, relatively stable growth. Further up is the yellow dot for equity or stock, which introduce higher risk alongside the potential for a higher return. Finally, on the far right, the red dot represents speculative assets, where the potential rewards are massive, but the threat of a severe loss is equally high. The critical takeaway here is that risk is simply the price of admission for achieving higher returns. There are no shortcuts in a finance, and asset promise outside return with zero downside simply does not exist in efficient markets. Next, let's talk about ranking this choice by placing assets directly onto a single risk spectrum. Every asset class occupies a definitive position on the continuum, moving smoothly from capital preservation on the left to a capital appreciation on the right. Let's zoom into the two most common foundational PR of a portfolio, bond and stock. On the left side of our spectrum, under moderate risk, we have bonds. These are fixed income securities that pay predictable, scheduled interest, while bond price do fluctuate as interest rate move. Their contractually scheduled payment make them the crucial ballast or anchors of an investment portfolio, keeping it steady as we move to the right into higher risk territory. We find stock. Buying a stock means buying equity ownership in a company's future profit because nothing is contractually promised or guaranteed. Price swing rapidly based on a company earning, market sentiment, and macroeconomic growth expectation. However, accepting that near-term volatility is exactly what gave you the potential for much higher long-term upside. Ultimately, building a portfolio is about balancing this piece across the exact continuums. To truly understand how this works, let's look at a concrete side-by-side example comparing a government bond to a technology stock. These sit at a completely different point on our spectrum. Let's look at the numbers and behaviors. First, volatility. A 10 years US Treasury note has a very low volatility with a gradual, modest price move. On the flip side, a growth stage technology stock experiences high volatility with double-digit swing happening with just a few months. Next, return. The bond offers a predictable typical annual return of about 3 to 5%, paid out a fixed interest. The tech stock is highly variable. It can easily exceed 20% in a good year, but it can also turn sharply negative. Now, look at the worst case behaviors. In a bad market, the bond might see minor, rat-raving price dip, but your principal is contractually returned at maturity. The tech stock, however, can experience steep drawdown of 30 to 50% or more during a downturn. Ultimately, their role in a portfolio are fundamentally different. You hold the government bond for a capital preservation and steady income, while you buy the technology stock for a long-term capital growth. Neither is better than the others. They simply serve different financial goals. To wrap up things, let's look at our financial compass, summarized in just one definitive sentence. Risk is not the enemy of the return. It is the absolute source of it. You cannot have one without other. As you step away from this briefing, keep these three final action in terms in mind. First, always match your investment to our personal roadmap. Align your position on the risk spectrum with our specific time horizon and personal tolerance for a loss. Second, don't force yourself to choose between extremes. Instead, diversify across the entire spectrum. Build a balanced portfolio that combines assets like a bond for a defense and stability with stock for emphasis and growth. And finally, protect yourself from a bad actor. Treat any product or advisor promising high return with absolutely zero risk as an immediate red flag, not a financial opportunities. Thank you all so much for your time today. I would love you to open up the floor to any question or thought you might have. See you soon for the next time.